Disclaimer.
Stop for a second. Can you feel it? What's happening with silver at $103 right now is not just bullishness, it's the sound of a door closing in the face of the entire fiat world. As you watch this video, Europe is dumping $12 trillion in US treasuries. It's a nuclear panic that's sending the value of your metal parabolically exploding to $200. Today, the rules of the game have changed forever. Yesterday, January 23rd, 2026. While most Americans were checking their retirement accounts and planning their weekends, something extraordinary happened in the silver market that should make every investor in this country pay attention. The price of silver exploded to $103.45 per ounce, shattering records and climbing higher than it had ever gone in human history. Think about that for a moment. Silver, the metal sitting in your jewelry drawer, the industrial commodity powering our solar panels and smartphones, just became more expensive than it's ever been. But here's what should really grab our attention. This wasn't some gradual climb over months or years. According to APMEX, one of our largest precious metals dealers, silver surged $5.80 in just 24 hours, rocketing to $99.15 before continuing its historic ascent. That's the kind of price action we typically see during full-blown financial crises, not on a random Thursday in January. What if I told you this explosive move has almost nothing to do with silver itself, and everything to do with a $12 trillion problem brewing across the Atlantic that most Americans don't even know exists yet? Here's where it gets interesting. While we were watching silver break records, European investors were sitting on a powder keg of American assets. We're talking about $8 trillion in US stocks and bonds held by Europeans who are suddenly questioning whether they want to keep holding our debt. Fortune magazine reported that $3.6 trillion of that total is parked in US Treasury bonds alone. That's not pocket change. That's more than the entire GDP of Germany sitting in our government bonds, held by investors who are getting increasingly nervous. And they have good reason to be nervous. Our 30-year Treasury yields just jumped to 4.93%, inching dangerously close to that crucial 5% threshold that historically triggers major portfolio reallocations. According to CNBC, this spike came right as President Trump threatened Greenland tariffs against our own NATO allies. And let that sink in for a second. We are threatening tariffs against our closest military partners while they are holding trillions of dollars of our debt. Pop quiz, what happens when the people lending you money start questioning the relationship? The answer is playing out right now in the silver market, and the mechanism is brilliantly simple once you see it. European bondholders need somewhere to park their money if they start unwinding these massive treasury positions. They can't just sell $3.6 trillion in US bonds and sit on cash while inflation erodes their wealth. They need hard assets. They need something real, something tangible, something that can't be printed by central banks or devalued by political decisions. Enter silver, and here's where the math becomes truly fascinating. Silver lease rates, which measure the cost to borrow physical silver for short periods, exploded to around 8% in January 2026. Trading Key notes that in normal years with ample supply, these rates sit at 0.3% to 0.5%. When lease rates spike like this, it tells us something critical. The people who actually own physical silver are refusing to lend it out, even temporarily. They're holding tight because they know something the paper market hasn't priced in yet. Meanwhile, on the other side of the Atlantic, European governments are preparing to flood the market with bonds. Amundi reports that gross issuance is approaching $1.4 trillion, while the European Central Bank is simultaneously reducing its holdings by around $384 billion. Net issuance will be the highest ever recorded. Think about what this means in practical terms. European governments need to find buyers for an unprecedented amount of new debt at the exact same time the ECB is stepping away as a buyer. Who's going to buy all those bonds? And more importantly, what happens when traditional buyers decide they'd rather own something else? This is where our story takes a dramatic turn, because the silver market isn't operating like it used to. Physical silver pricing on the Shanghai Gold Exchange has decisively broken away from Western paper benchmarks. Bullion Star reports premiums reaching approximately 12 to 13% above the London Bullion Market Association, spot prices, and COMEX futures prices. Read that again. The same ounce of silver trades for 12% more in Shanghai than it does in New York or London. We now have a two-tier market, paper silver in the west, physical silver in the east, and the gap between them is widening by the day. Here's what that means for you and your portfolio. The LBMA, which serves as the backbone of the Western silver market, had eligible silver stocks shrink to only about 155 million ounces. Meanwhile, Trading Key points out that floating annual demand runs at 900 million to 1.2 billion ounces. Let me put those numbers in perspective. The available inventory in London's vaults represents less than 2 months of global demand. It's like a grocery store stocking enough milk for the next 6 weeks while serving a city that drinks milk every single day. Now imagine what happens when even a small portion of those nervous European bondholders decide to convert their paper assets into physical silver. The mathematics become brutal very quickly. Silver's entire above-ground market capitalization sits around $100 billion. Compare that to the $3.6 trillion in U.S. treasuries held by Europeans. If just 3% of that European treasury position rotates into silver, we're talking about $108 billion, trying to squeeze into a $100 billion market. And remember, that $100 billion market cap assumes all the silver in the world is for sale at current prices, which it absolutely is not. Have you noticed what's happening at your local coin shop lately? Try buying substantial quantities of physical silver at spot price. You'll quickly discover that premiums have exploded, delivery times have extended, and dealers are getting choosy about large orders. That's not a supply chain issue. That's a market in the early stages of a squeeze. The warning signs are everywhere once you know where to look. Banks and asset managers are already adapting to this new reality. White & Case LLP reports that major financial institutions are allocating more capital to precious metals in their portfolios as a longer-term hedge against bond market volatility. These aren't retail investors buying a few coins for their safe. These are institutions with billions under management making strategic shifts based on what they see coming. Think about this scenario for a moment. You're a European pension fund manager with $10 billion in U.S. Treasury bonds yielding 4.93%. Your political leaders are in a trade dispute with the United States over Greenland, of all things. The European Central Bank is shrinking its balance sheet, which means bond prices could fall when they need to sell the most bonds in history. Your currency union has fundamental structural problems that have never been fully resolved. What do? You start looking for alternatives. You start thinking about assets that can't be devalued by decree, that aren't someone else's liability, that have industrial demand supporting their floor price but financial demand driving their ceiling. You start looking at silver, and you discover that the cupboard is nearly bare. Those 155 million ounces in London, that's 6 weeks of supply at current demand, and current demand doesn't include what happens when institutional money floods in. The physical market can't absorb the kind of capital rotation we're discussing without prices adjusting dramatically higher. It's not a matter of opinion. It's basic supply and demand mathematics. What makes this situation even more precarious is that nobody saw it coming quite like this. The assumption built into our entire financial system was that paper claims and physical delivery would always trade at roughly the same price. That assumption just failed in spectacular fashion when Shanghai started trading at double-digit premiums to London. The assumption was that there would always be enough physical metal to satisfy redemptions. That assumption is being tested right now as lease rates spike and dealers struggle to source metal. The assumption was that European and American financial interests would remain aligned. That assumption died the moment tariff threats entered the conversation between NATO allies. We're watching multiple assumptions fail simultaneously, and the silver market is where all these failures intersect. It's the perfect storm of inadequate supply, surging demand, geopolitical tension, and a bond market crisis that hasn't fully erupted yet, but whose tremors are already shaking foundations. The 103.45 record that silver just set, that might not be a peak. That might be the warning shot before the real action begins. Let's talk about what actually happened yesterday with hard numbers, because the evidence is so compelling that even skeptics need to pay attention. Trading Economics reported that silver rose to a $102.95 per ounce on January 23rd, up 7.06% from the previous day. But here's where the story gets truly remarkable. Prices were up 43.09% over the past month. Read that again. Silver gained more than 40% in 30 days, and compared to the same time last year, we're looking at a 236.76% increase. That's not a bull market. That's a monetary event. What's driving this explosive move? According to Trading Economics, we're watching a weakening dollar triggered by shifting Europe geopolitical dynamics over Greenland, combined with growing concerns that Europe could weaponize its substantial U.S. asset holdings. Think about what that means in practical terms. Our closest allies, the people we've defended militarily for decades, are now being discussed in financial circles as potential adversaries who might dump our bonds as a strategic weapon. Have you checked your bond portfolio lately? If you're holding treasury funds in your 401k, you need to understand what's happening right now, because the ripple effects are already spreading across global markets. CNBC reports that Japan's 40-year government bond yields just hit a record high as global bond markets sell off on tariff-fueled trade war fears. Japan, one of our most reliable treasury buyers alongside Europe, is seeing their own bond market crack under pressure. When the world's most stable bond markets start breaking records for the wrong reasons, it tells us something fundamental has shifted in the global financial architecture. But the real proof that something unprecedented is unfolding lies in a price divergence that shouldn't exist in efficient markets. In early 2026, the assumption that nobody would ask for delivery all at once completely failed. Trading Key documented Shanghai spot silver trading at premiums of nearly 10% over COMEX futures. Let me explain why this is so significant and why it should concern every American with savings to protect. COMEX is our futures exchange in New York where most silver price discovery happens for the Western world. It's supposed to reflect the true price of physical silver. Shanghai is where actual physical metal changes hands in Asia. In a properly functioning market, these prices should be nearly identical after accounting for shipping costs and currency conversion. A 10% premium means Chinese buyers are willing to pay $10 more per $100 ounce just to get actual metal in their hands, rather than paper promises from Western exchanges. That's not a small arbitrage opportunity. That's a scream from the physical market telling us the paper market is broken. Think about this scenario from a trader's perspective. You could theoretically buy silver on COMEX at $100, immediately sell it in Shanghai for $110, and pocket a 10% profit. Except you can't, because there's no physical silver available to deliver against those COMEX contracts in quantities large enough to exploit the arbitrage. The premium exists precisely because the metal isn't flowing from west to east anymore. The cupboard is bare and the price divergence is proof. Rising short-term lease rates provide even more evidence that holders of metal are increasingly unwilling to lend silver even temporarily. Remember those 8% lease rates we discussed earlier compared to the normal 0.3% to 0.45%? That's a 16-fold increase in the cost to borrow silver for short periods. Bullion Star warns this creates scenarios where ETFs may have to suspend redemptions or be forced into cash settlement as physical metal effectively disappears from the market. Let that sink in for a moment. You might own shares in a silver ETF believing you have exposure to physical silver, but when you try to redeem those shares for actual metal, you could be handed cash instead at whatever price the fund decides is fair. You thought you were protected against currency debasement, but you're actually holding another form of paper that may or may not be backed by real metal when the crisis hits. Now let's talk about what happens if Europe actually pulls the trigger and starts unloading treasuries in size. Fortune magazine put it bluntly: bond prices would tumble in very violent fashion, with spillover effects in the Eurozone where borrowing costs would spike. This isn't speculation. This is financial mechanics. When large holders dump bonds, prices fall and yields rise. When yields rise in the US, they rise everywhere because global capital flows to wherever it's treated best. Here's where it gets personal for American investors. Your retirement account probably holds bonds either directly or through target date funds. Your pension fund definitely holds substantial treasury positions. Your bank's balance sheet is loaded with government securities. When Fortune uses the phrase very violent fashion to describe potential treasury price moves, they're talking about your financial security taking a hit that could erase years of careful saving. But here's the cascading effect that most people miss. White & Case LLC. Now let's talk about where this goes from here, because the mathematics are brutal and the timeline is compressed. We need to understand what $200 silver actually means, why it's not just possible but increasingly probable, and when we might see it happen. The numbers tell a story that should make every American investor reconsider their portfolio allocation before it is too late. Start with historical context. AppMex points out that the 1980 record of $49.45 would adjust to $194.42 per troy ounce in 2025 dollars, or about $200 per ounce depending on which inflation formulas you use. So when we talk about $200 silver, we're not discussing some fantastical moonshot. We're discussing silver returning to its previous inflation-adjusted high from 45 years ago. But here's what makes this time different and potentially more explosive. Silver already hit $103.45 in nominal terms yesterday. We're already more than halfway to $200 in absolute price terms, and we haven't even seen the full impact of the European bond crisis yet. We're running this race with a head start that didn't exist in 1980. Now add in what's happening with gold, because the two metals are joined at the hip by centuries of monetary history. Trading Economics reported that gold hit $4,191 on January 20th, 2026, just 3 days before silver's record surge. Think about those two data points together. Gold at nearly $5,000 per ounce and silver at 103. The gold to silver ratio sits around 50 to 1 at these levels. Here's where the calculation becomes fascinating. Historically, when gold and silver both surge in crisis conditions, the ratio compresses. Silver becomes more valuable relative to gold because industrial demand combines with monetary demand, and silver's smaller market size means the same dollar inflows create bigger percentage moves. If we maintain even a 50 to 1 ratio and gold reaches $10,000 per ounce, the math says silver hits $200. Is $10,000 gold realistic? JP Morgan thinks so. According to their research, they forecast gold averaging $5,005 per ounce by Q4 2026 and rising toward $5,400 per ounce by the end of 2027. And that's their base case, not their crisis scenario. If European bond markets deteriorate faster than expected, if Treasury selling accelerates, if inflation proves stickier than central banks hope, those numbers could be conservative. What if I told you the setup for $10,000 gold and $200 silver is already in motion and the catalyst arrives in the next 6 months? Let's walk through the mechanics step by step, because understanding how we get from here to there is crucial for timing your positioning. You're already nervous about holding US Treasuries because of the geopolitical tensions and tariff threats. Now, your own government is flooding the market with European bonds at the same time the ECB is stepping away as the buyer of last resort. Where do you turn? You can't pile into more bonds. You're trying to get away from bonds. You need assets that benefit from the chaos rather than assets that are the chaos. Precious metals suddenly look very attractive, and silver offers something gold doesn't. Silver is cheaper per ounce, which means you can accumulate larger physical positions. Silver has industrial applications that provide a fundamental demand floor, and silver is in a proven supply deficit, while gold has surplus production. If you're trying to position for a bond market crisis, silver gives you more explosive upside potential. Now here's the mathematical trap that snaps shut on the paper market. LBMA's 155 million ounces represents only 6 weeks of supply at current demand levels according to TradingKey. 6 weeks, not 6 months or 6 years. 6 weeks of global consumption, and that's before we add in any panic buying from distressed bondholders. Let me put this in terms that hit home for your investment portfolio. Silver's entire above-ground market capitalization is roughly $100 billion at current prices. That sounds like a lot until you compare it to the $3.6 trillion in US Treasuries held by Europeans. If just 2 to 3% of that European Treasury position rotates into physical silver, we're talking about $72 billion to $108 billion trying to squeeze into a $100 billion market. And remember that a $100 billion market cap assumes all the silver in the world is for sale at today's prices. It's not. Industrial users need silver for manufacturing, and they're not selling. Long-term holders who understand the supply deficit aren't selling. The 155 million ounces in London vaults isn't all available at 103s. Much of it is already committed, already leased, already spoken for. The available float, the metal that could actually change hands in a crisis, might be 20 or 30% of that total. Call it 30 to 50 million ounces of truly available silver in the entire LBMA system. Now run the math on $72 billion chasing 30 million ounces. The numbers become absurd very quickly. We're talking about instant supply exhaustion and price discovery moving into triple digits within days, not months. History gives us a preview of what happens during acute scarcity. Silver lease rates spiked to 50 to 200% annualized levels during periods when the physical market seized up. We're already seeing rates at 8%, which is 15 times normal. If rates explode to 50 or 100% as they did in previous crises, it confirms that every available ounce has been borrowed and there's nothing left to lend. Then add in the geopolitical wildcard that just activated on January 1st, 2026. Discovery Alert reports that China implemented export restrictions affecting 120 million ounces of annual production. China isn't just the world's largest silver producer. China is also the world's largest silver consumer for industrial applications. They're keeping the metal at home, which removes 120 million ounces from the global market that Western buyers were counting on. Do the math with me. Global annual demand runs at 900 million to 1.2 billion ounces. China just removed 120 million ounces from exportable supply. LBMA has 155 million ounces total, representing only 6 weeks of demand. If European institutions start rotating even small percentages of their bond holdings, we're not talking about a supply squeeze. We're talking about a supply apocalypse. And here's the part that should terrify anyone holding silver ETFs believing they're protected. Bullion Star warns that ETF shares may continue trading while the underlying metal effectively disappears from the market, creating counterparty risk where investors believe they own silver but hold only paper claims. You'll watch your ETF shares trade on the stock exchange at $150 or $180 or $200 per share, but when you try to redeem them for physical metal, you'll discover there's no metal to deliver. You'll be forced into cash settlement at whatever price the fund administrator decides, probably at a discount to the surging spot price, because they need to buy metal on the open market to settle your redemption, and there's no metal available at reasonable prices. You thought you were protected. You're actually exposed to the same counterparty risk as any other paper instrument. This is why the